Let me ask you something, and I want you to actually sit with this for a second. Have you ever stood in a grocery store, doing the mental math in your head, trying to figure out if you can afford to add one more thing to your cart, and felt this quiet, low-grade shame? Like you should already know how to handle money better than this? Or maybe you've sat across from someone who casually drops the phrase, my portfolio, or my equity, and you just nodded along, smiling, secretly wondering if you're the only adult who doesn't quite understand how any of this actually works. You're not. Not even close. The truth is, most people go their entire lives interacting with the financial system every single day, spending money, borrowing money, earning money, without ever once being taught what the system actually is. And that's not your fault. That's by design. So today, I want to fix that. Not with jargon, not with a lecture, just like two people sitting down and finally making sense of something that was always made to feel more complicated than it needed to be. Here's the thing that nobody tells you. The financial system isn't some natural force like gravity. It didn't just exist. People built it. Humans sat in rooms, made agreements, and constructed this entire architecture of money and rules and institutions. And like anything humans build, it has quirks, it has flaws, and it very much favors the people who understand how it works. Most of us were taught to interact with money but never to understand it. You were taught to work, to spend, maybe to save a little. But the deeper mechanics, the why behind all of it, that was left out of school, out of most dinner table conversations, and somehow always assumed to be someone else's department. And that gap, that space between using money and understanding money, is where a lot of anxiety lives. Because when you don't understand a system you're trapped inside, everything feels a little bit helpless. You feel like you're playing a game where everyone else knows the rules and you're just guessing. So let's change that. Let's actually understand the game. Okay? Start from the very beginning. Money is, at its most fundamental level, a shared agreement. That's it. A piece of paper with a number on it has no inherent value. A digital number in your bank account is just a number in a database somewhere. The reason these things work, the reason you can hand someone a 20-euro note and walk away with a coffee, is because we all, collectively, agreed to believe in it. Historically, this wasn't always the case. People used to trade things directly. You have wheat, I have shoes, we swap. But that gets complicated fast. What if I need shoes and you don't need wheat right now? So humans invented money as a kind of middle layer, a universal placeholder for value that everyone could agree on. For most of history, that money was tied to something physical, usually gold. The idea was, each note you hold represents actual gold sitting in a vault somewhere. This was called the gold standard. In 1971, the United States, and eventually most of the world, moved away from that. Now your money isn't backed by gold. It's backed by trust. Trust in governments, trust in institutions, trust in the system itself, which sounds fragile, but it's actually held together pretty well because the alternative, everyone going back to trading wheat and shoes, doesn't scale. So money is trust, made tangible. Now you might be wondering, if money is just a shared agreement, who gets to decide how much of it exists? This is where central banks come in. In Europe, it's the European Central Bank. In the US, it's the Federal Reserve. These are institutions, not quite government, not quite private, whose job is to manage the money supply and try to keep the economy stable. They have one particularly powerful tool: interest rates. Think of interest rates as the price of borrowing money. When rates are low, borrowing is cheap. Businesses borrow to expand. People borrow to buy houses. The economy moves faster. When rates are high, borrowing is expensive. People spend less. Businesses pull back. The economy slows down. Central banks raise and lower these rates like someone adjusting a thermostat, trying to keep the economy from running too hot or too cold. You've probably noticed that when inflation spikes, when everything from your rent to your groceries suddenly costs more, interest rates go up. That's the central bank deliberately trying to cool things down. Expensive borrowing means less spending, and less spending means prices eventually stop rising as fast. It's an imperfect system. It has side effects, but it's the mechanism. Okay, so now we have money, and we have a central bank managing its overall supply. But how does money actually reach you and me on a day-to-day basis? Through commercial banks, the banks you actually have an account at. Here's something that genuinely surprised me when I first learned it. When you deposit money into a bank, the bank doesn't just hold it there, safe and untouched, waiting for you to come back for it. The bank takes most of that money and lends it out to other people. They keep a fraction in reserve, enough to handle normal withdrawals, but the rest goes out the door as loans. This is called fractional reserve banking. So if you deposit €1,000, the bank might lend out 800 of it to someone buying a car. And that person spends it, and the car dealer deposits it in their bank, and their bank lends out most of that. And on it goes. This process actually creates money. Not physically printing it, just expanding the supply through lending. It sounds wild, but it's how the modern economy functions. The risk, as you might imagine, is if everyone tries to get their money back at the same time. That's a bank run. It doesn't happen often, but when it does, it can be catastrophic, which is why governments typically guarantee your deposits up to a certain limit. In the EU, that's usually €100,000 per bank, so that people feel safe enough not to panic. Let's talk about something that sounds intimidating, but is actually pretty elegant in concept. When a company needs money to grow, to hire people, build products, expand, it has a few options. It can borrow from a bank, or it can sell pieces of itself to the public. Those pieces are called shares, or stocks. If you buy a share in a company, you own a small fraction of it. If the company does well and becomes more valuable, your share becomes more valuable too. If it does poorly, the opposite happens. The stock market is just the place where people buy and sell those shares with each other. Prices go up when more people want to buy than sell. They go down when more people want to sell than buy. And here's where psychology enters the room. The stock market isn't purely rational. It's human. It's driven by expectations, fear, optimism, news cycles, rumors, and collective emotion. A company's share price isn't always a perfect reflection of how the company is actually doing. Sometimes it's a reflection of how people feel about how it might do. That's why markets can fall sharply even when the underlying economy is fine, and why they can seem irrationally high even when things are shaky. People are always pricing in the future, and nobody actually knows the future. Now let's talk about something more personal. Debt. Most people have a complicated relationship with debt. Some see it as shameful, something to be avoided at all costs. Others use it without thinking, swipe their card, and worry later. But debt, understood correctly, is just a tool. Like most tools, it can build things or it can hurt you depending on how it's used. There are two kinds of debt worth understanding. The first is debt that grows your life in some way. A mortgage that lets you own a home that might appreciate in value, a student loan that opens doors to a higher income, a business loan that lets you build something. These aren't automatically good decisions, but they have a logic to them. The second kind is consumer debt. Credit cards, buy now, pay later schemes, personal loans for things that don't hold value. These are structured, deliberately, to be expensive. The interest rates on credit cards often sit between 15 and 25% per year. That's designed to make the debt hard to escape. The financial industry is extraordinarily good at making debt feel effortless in the moment. Tap your card. Click confirm. Worry about it later. That friction-free experience is engineered. Because the easier it is to borrow, the more profit flows to the lender. This doesn't make you weak for falling into it. It makes you human, responding to systems that were designed by very smart people to capture exactly that human tendency. Here's the realization that changed how I see all of this. The financial system isn't a neutral backdrop. It's not like the weather, something that just happens around you. It's a set of rules that were written by people, and rules written by people can be understood by people. And once you understand them, you stop being someone the system happens to, and you start being someone who can make intentional choices inside of it. That shift, from passive participant to conscious actor, is less about how much money you make and more about how clearly you see what's going on. When you understand that banks profit from debt, you start looking at interest rates differently. When you understand that stock prices reflect emotion as much as reality, you're less likely to panic sell every time there's bad news. When you understand that inflation is the slow erosion of your money's buying power, you understand why just leaving everything in a savings account isn't actually safe. None of this requires a finance degree. It just requires that someone finally explain the game. And here's the part that actually matters for your life right now. The system rewards patience and consistency far more than it rewards intensity or luck. The person who puts aside a modest amount every month and lets time do the work will almost always come out ahead of the person who makes one big bet, hoping to catch up later. Compound interest, The idea that your returns earn their own returns is genuinely one of the most powerful forces in personal finance. It's slow, it's boring, and it works almost every time, given enough runway. So what does this actually look like in real life? First, understand where you stand. Not in a judgmental way, just factually. What comes in each month? What goes out? What's the gap? This isn't about making a perfect budget spreadsheet and sticking to it forever. It's just about seeing clearly. You can't navigate somewhere you can't see. Second, treat high-interest debt as the priority it actually is. If you have credit card debt at 20% interest, paying that off is the equivalent of earning 20% on an investment, which you can't reliably find anywhere else. Clearing that is investing in yourself. Third, if you can, build a buffer. Not a number from a self-help book. Just something that means one unexpected bill doesn't derail everything. Even a month of basic expenses sitting somewhere accessible changes how stress operates in your life. You make better decisions when you're not operating in permanent financial anxiety. Fourth, start understanding investing, even passively. You don't need to pick stocks. Index funds, which just mirror the performance of a whole market rather than betting on individual companies, are how most ordinary people can participate in long-term economic growth without it becoming a second job. The research on this is remarkably consistent. And finally, please, be patient with yourself on all of this. Financial literacy isn't something you missed because you weren't paying attention. It's something the system never bothered to properly teach you. You're allowed to be starting from wherever you are. I want to leave you with something simple. The financial system is large and complicated and sometimes genuinely unfair. That's true. There are structures in it that favor certain people and disadvantage others in ways that aren't just about personal choices. I don't want to pretend otherwise. But within that reality, understanding how the system works is one of the quietest, most durable acts of self-respect you can engage in. Not because money is the point of life, but because financial clarity creates space. Space to think, to choose, to actually live on your own terms rather than just reacting. You don't need to have it all figured out. You don't need to become someone who talks about markets at dinner parties or reads financial reports for fun. You just need enough understanding to make a few better decisions, a little more consistently, over a long enough time. That's it. That's actually the whole game. And don't forget to subscribe, like, and leave a comment, then you're really ready for it.